Right. All right, Karishma, thank you very much for bringing that exclusive details for the auto space. Now, as promised, let's shift focus and talk about petrochemicals. Debasish Misra of Deloitte is right here. Just to set the context, it was petrochemicals within the petrochemical world. Oil to chemicals is a new phenomena which is being discussed across the world. And in fact, the chairman of country's largest refining company for the first time spelt out the word oil to chemicals, referring to the commodity business in their AGM last year, hiving off as a separate company. And since then, globally, there's a surge in this usage, oil to chemicals. What exactly does it mean? Is it a field of petrochemicals, or is it got to do with oil refining? Let's discuss all of that, and what does India, how does it impact India? Debashish, thank you very much for joining us for this special discussion today. You are somebody who works with similar companies, petrochemical companies, chemical companies, oil companies in the entire region. Tell us what exactly is the surge in oil chemical, O2C, oil to chemical narrative, and what exactly does it mean?
Thank you, Ajay. Thanks for having me over. You just had a breaking news on the auto sector. So auto sector, as you know, that it's going through a lot of turmoil right now, but also the future of mobility is changing really fast. So future of mobility will be connected vehicles, it will be shared, autonomous, and overall, over and above everything, the biggest shift is it's going to be more and more electrified. So one is expecting more adoption of electric vehicle throughout the world, more in the OECD world, and our parts of the world also. We are expecting that gradually, if you see the Niti Aayog papers and other things, that we will shift towards electric vehicle. So as a result, what is happening is the petrol and diesel, the liquid fuel demand will probably gradually, it will taper off and come down in certain parts of the world earlier than it was expected. So what will happen to then all these refineries? So people are already planning for that. And some of the companies are pretty ahead of the game in terms of what do we do with this crude. As you know, I mean, very interestingly for your audience, the crude, the oil has a variety of use. We usually in a conventional term think that it gives us petrol and diesel. It will be very interesting for your viewers to know that a barrel of oil, it can give you 40 liters of diesel. It can also give you 40 polyester shirts or 650 toothbrushes. So as a result of increasing, polymer and plastic consumption throughout the world, now companies are thinking of moving more towards output which caters to such demand and catering to how the future of mobility going to be. So the conventional, refiners who were at best were integrated as refining and petrochemical complex, they are moving towards straight from a crude to chemical kind of complexes. And that's what is the new thing, what is happening throughout the world.
Sure. Deb, so essentially what you're saying is that, right from when crude was actually found, the usage of crude is being redefined with every, kind of an industrial phase. And now the way we are entering into a new world where demand of traditional fuels for auto is going down, again, crude oil is being refined into newer products of demand which are emerging. So sweating out the same barrel of oil into better uses. Talk to us about which are the sectors globally where these chemicals which are being derived out of the same barrel of oil, the 40, 50, 60% more chemicals, which are the demand drivers, which sectors are we talking about globally which are witnessing higher usage for these newer chemicals?
So I think yesterday or day before you had a show which was basically when you had told your audience that it's kind of a golden age for the chemical sector. And as I was telling in my opening remarks, a traditional refinery cum petrochemical complex, it gives at best 8 to 10% chemical output per barrel of oil. So in the whole concept of crude to chemical, we are talking about a benchmark in excess of 40% per barrel of oil. So it is a huge change in the entire configuration. And coming back to your question of which all segments we will need, this kind of chemical usage. Going forward, if you look at whether it is agrochemical, dyes or pigments, or construction chemical, specialty chemical, so the usage would be so widespread, it's unbelievable. And if you look at where India is today our plastic consumption is around 10 to 12 kg per capita, whereas countries like US, it has reached 85 kgs. And as the country's per capita GDP is around crossed around $2,000, per capita plastic consumption, which is discretionary usage of material, would significantly increase. And we are a net importer of both chemical and petrochemical. So there is a huge domestic market to be tapped also. So both the segments, chemical and petrochemical, has a huge potential for investment in India.
Sure. How is this change in phenomena globally relevant to Indian refining assets? Not talking about specific companies, but we know that one of the large private sector refiners right now is looking at partnering with global biggies. Here, even the PSU refining assets are being eyed again by global investors. Suddenly, why is there eagerness to look at Indian O2C assets or possible O2C assets? Can it be because of rising demand domestically, or do you think India can be a base for exports in the region? What is the strategic play behind this in your view?
So both, I mean, you rightly pointed out, given there are three things. One is the import substitution. Second thing is obviously a rising demand of plastics and polymer as such, and that will be in double digits for next 2 decades. And also India can be definitely a base for exports. And if you look at the entire region, there is a lot of these oil to chemical companies and investments are coming up in the Middle East and in China. In fact, the company which has a stated policy in focusing on crude to chemical, oil to chemical, is the largest company in the world, which is Saudi Aramco. And that, as you know, it is the largest oil producer. It has around 10 million barrel per day of production. It has a stated policy of having at least, diversifying from upstream and having 8 to 9 million barrel of refining capacity. And they want at least 4 to 5 million barrel output per day of chemical capacity. So what they are doing is now they have, there is a large, Aramco SABIC deal, which is almost $75 billion deal. Aramco also has a joint venture now with Chevron. They have invested in Chinese company, which is Zhejiang. And as you know, they are also keen, and they have signed the MOU with Indian government to take a stake in our West Coast refinery. And West Coast refinery, by the way, although it's still on the drawing board, while they're being there on the drawing board, it will also have large amount of chemical output compared to a traditional, refining complex in India currently. So that's going to be the future, and that's where the action is going to be in future. That's why the global companies are very keen on investing in some of those opportunities in India.
Right. One last question, Deb, because you do engage with a lot of global investors as well as part of your work and in your community. Do these global investors look at O2C assets differently? Are these valued better because of their complex output and much more sophisticated output than traditional refineries, and hence perhaps it may also be important for Indian refiners to move in that direction?
Absolutely. So as you are aware, I mean the crack spread, which is basically the difference what value addition a refiner is doing to crude to their output, whether it is petrol, diesel, and other kind of output, that's under tremendous pressure. And pre-COVID also the crack spread, which reflects in obviously the refinery margin, which you guys track very closely along with the analyst. That has been under pressure. Whereas, as I mentioned, the chemical value addition is tremendous. And what you get for a barrel, if you really are doing oil to chemical with 40% plus output, you obviously your margins will be much better than a traditional process. So hence, going forward, investors are also pretty excited about this story. And they would value it much better than a traditional, refining story. Obviously, I mean that goes without saying.